Good afternoon, everybody. I guess we're live here. Today is Wednesday, the 15th of September, 2010. And let's go ahead and take a look at this market. As we know, a lot of people were expecting that when we came back, Upside was pointing this out, that, I thought all the volume was going to return to the market is what they were telling us. But again, it's only price that pays. The people who really harp on volume a little bit too much, I think, generally there's been some great trading opportunities in some of the stocks, and the market's right up against the high end of this range. I think there's just a general indecision here right now as people are trying to decide whether this rally is for real and if it's something that's going to break out and complete this inverted head and shoulders pattern on the daily time frame, which we've also, of course, been observing here on the weekly time frame. It's maybe a little bit more meaningful to see here on the weekly time frame. So let's just kind of change that scaling without getting you guys dizzy. And the 113 and 113.25, let's call it, is really a level a lot of people have been looking at. What we have to be aware of is the false breakout as well. A lot of times we get, a cheap little breakout past these highs, and then the market will come back in. From a failed move often comes a fast move. You have to think about the psychology of the participants. And like I always say, we want to ask ourselves, let me redraw that, we want to always ask ourselves two questions. One, where has the market come from? Well, in the last 2 weeks, we've seen it rally from 104.5 up to 113. So we've seen a rally of a little less than 10%, maybe about 8%, I guess. So we've seen this one come up to the so we've expended quite a bit of energy getting here, and now seemingly running on fumes. And now, where did it have the potential to go before it's likely to encounter supply? Well, we're right there. So does that mean you should sell short? No, because looking at the intermediate term time frame, we're still above this rising 5-day moving average, and we're still showing a pattern of higher highs and higher lows. We've turned more neutral, obviously, this week, the last 3 days, since the gap up on Monday. And if we take a look at the 3-day chart, that is just Monday through Wednesday here we've got the volume weighted average price of the week to date. Today we gapped down, and once again, this is just another day where really we'd seen the market gap down, kind of turn sideways, rally back above that VWAP, and then take out that opening range, and then it took off and stayed above the volume weighted average price all day long. So when you're above a rising volume weighted average price on the daily time frame, you give it the benefit of the doubt to the buyers. If we had been below a declining volume weighted average price, it would have been okay, I think, to sell short on a day trading basis. But when we have the conflicting signal from this rising 5-day moving average, then any and let's look at that 30-minute time frame again, then any short trade should be just for a day trade. So you can look at this thing and say, hey, we're up too much, we're at resistance, we're at this level where we've seen resistance before, and so far we're pausing. But the market can correct two ways. One, it can correct by pulling back price-wise, and maybe it's going to pull back, find some support near these rising moving averages, and then suck in some short sellers and then blast off. That would really be the preferable thing here, is maybe a pull back down towards 111.5 or so. So a low volume pullback through price, or we can consolidate these gains through time. Now, a time consolidation can break down as well. The more time it spends kind of going neutral, the more energy that's built up. So a break in either direction will generally be something that you want to pay a little bit more attention to. If you look at some of the individual stocks, they've been holding this 5-day moving average very well. There was one I was looking at, what was that? MHC is one of the, been a real strong, now it's oh shoot, I shouldn't have even brought it up. Oh well. Maybe we could look at CRM. So you see, when these stocks break the volume weighted or the 5-day moving averages, they're okay for day trades, but especially when we have them below the volume weighted average price for the day. Let's look at CRM. But generally, just the sum of the rallies in an uptrend, there's always going to be more opportunity than there is on the sum of the declines. That's what makes it an uptrend on that bigger time frame. And so we look at this SPY again, and we have to look at it and say we're at a pretty important area. And There, it wasn't switching. We're at a pretty important area, so as I said last night, it's time to let the foot off the gas a little bit here and see how this market absorbs the gains. So a lot of stocks have been moving higher. I think you want to be trimming some of those positions because when we get this extended, a lot of times we can see a gap lower, and then you want to have some cash available. If it takes off to the upside, then it takes off to the upside. But that's not really what's most likely here after the magnitude of the rally we've seen for the last couple of weeks. So you have to just be prudent in your money management according to not just the stocks you're in and that sort of thing, but where the overall market has come from, and how much energy it's expended, and that sort of thing. So we look at the Nasdaq up another 30 cents today. So the Qs have broken above really, or actually I'm sorry, that's not true. They're really right at the June highs. Last time we backed off this level very violently, and here we are. Nice rally, extended also, but clearly no signs of a breakdown. Now, if it's the gap lower, below 47, let's say, and stay below that 5-day moving average, then I think you would really want to move quickly to the sidelines in a lot of your positions, and look for the just a more defensive posture, and look at some of the weaker stocks to be short, because there are still some stocks that are shorting. Shortable, that is. Tempur-Pedics, kind of breaking down in here lately. Ingersoll Rand IR experienced this gap lower, and this stock has a pretty weak looking daily time frame. So there are still some opportunities, but the odds just aren't as strong for success on the short side when we have these really strong rallies in the overall market. So again, keep an eye on these little trend lines that have developed in these markets. So that's really, 47 seems important in the Qs. Just above that, these the highs from Monday basically held as support on the weakness this morning. So 47.30, 47 below that, and then we're looking at coming into this gap area. A lot of people, short, thinking that a gap always gets filled, and eventually maybe they do, but look at this gap hasn't been filled, this gap hasn't been filled, and this gap hasn't been filled. So shorting for a market to come back into the gap, to me, is really not a high odds strategy. But looking back at the SPY in the 30-minute time frame, we're riding this trend line, we're getting more hits upon it, so it becomes more likely that a trend line break and perhaps a break of support at that 112 level will come. But just be aware of that's the possibility. It's not making a pattern of lower highs and lower lows, so the odds are not there for the short side right now. The Russell 2000, it was up another 0.57%, and the key level in here that I've been telling subscribers we want to see hold this week is pretty obvious. It's the prior resistance. It's where we gapped up on Monday, and that level is at about 64.50. So this resistance holding as support right now, and we tested that rising 5-day moving average. We are still, we're a little bit neutral in here, but neutral within this pattern of higher highs and higher lows on the 30-minute time frame. So I wouldn't really be too concerned about the Russell 2000 unless it broke below 64.50 and held below that. And now that area is of greater significance because it's where we have the 5-day moving average as well. On the daily chart of the Russell 2000, the bigger level is really probably up at about 68. We'd made note of these trend lines being broken on the daily time frame. In actually all of these markets that we were talking about this trend line here on the SPY, and in the Qs we'd seen this trend line break Monday. Russell 2000, same thing. The semiconductors were down a little bit today, but still holding on, and this is going to be the more important higher low. And again, this is the area 25 and a half, really 25 to 25 and a half, that sucked in a lot of short sellers, and now we're still seemingly magnetized maybe towards that 50-day moving average. It's about $26.65 right now. But on a 30-minute time frame, here's the important level of support. We tested that today and bounced from it, so that's good to see. This 25.90. If the market, if the semis break below that and put a lower low in with this lower high, then we might look at this as a failed break, and then we're going to come, pop back down below that 25.5 level. The financials were up 5 cents, and they're really holding on to these gains pretty well. They were right at the 200-day moving average, or they've backed off that here the last 2 days, but really pretty impressive action. But again, it's until we really get decisively above 115, all these markets have been pretty range bound for the last several months, and we're at the top end of the ranges. So you don't want to get overly excited about the breakout scenario, but you look at it and look down at the 30-minute time frame. We're testing this trend line. We're testing that 5-day moving average, and you could say maybe they're getting a little bit more aggressive to the downside because we have these lower highs and lower lows. But right now, I think that the more important level is about 1460, and what I was saying yesterday is basically 20 cents down to 1440, and then at 1420 are really what I think are some of the more important support levels. At 1430 as well is approximately where that 50-day moving average is found. So that might take some significance, but generally the market is holding up it's holding up real well, actually. The the mining stocks, the GDX broke out yesterday and kind of came back in, but these miners have been real strong lately. They have this handle and cup, or if you wanted to call it a cup and handle, whatever, it doesn't matter. The weekly time frame, we're up at these levels that are very close to the all-time highs for the GDX, and a lot of the components, obviously, that I'd spoken about have been strong as well. The one I've been most focused on is this SLW. Not SLW, but the SWC. This was a good one yesterday and today as well. I'd spoken about this one yesterday, purchased it in here, and then yesterday afternoon tweeted about it there. For subscribers, we got involved above this level as an official idea today. But still, SWC Stillwater is performing real well. I'd mentioned the Perigo yesterday on Twitter, PRGO, 2 days ago actually, and this stock's been super strong. So there's a lot of stocks to focus on that are acting, that they're acting strong, and even the ones that look like they're breaking down. This, we were talking about Mastercard. This was on the watch list Monday for subscribers to short on weakness. Well, and what I had warned was if we don't get that weakness, Mastercard could experience a pretty violent short squeeze rally, and that's exactly what did happen. I think a lot of shorts got stuck in this Mastercard, and same thing with Visa. The short side of the market is more difficult in here. The stocks just aren't holding declines. They are holding on to their gains for the most part, though. So, anyways, that's really about all I had to talk about. So why don't we take a look at the Twitter stream and see if you guys want to talk about any particular stocks. Let me just scroll down here a little bit. And Fibline, Darren, Doug, thank you for the retweet. Don't Let Me Up is asking about Humana. Humana is one I had spoken about. We had subscribers in this one right in here, and we got out on I think it was Monday, or maybe it was Friday. I really don't remember. I think it was Monday. But it's pulling back. It's still a little bit extended. We've still got a pattern of lower highs and lower lows here. So we've still got, here's a stage 2 uptrend, stage 3 distribution, stage 4 on the short term, on a 10-minute time frame. We're looking at stage 4. So it needs to probably consolidate a bit for another couple days before we could get this stock to really get up and rally once again. But it's definitely worth keeping on your radar because you have this really nice breakout on the weekly time frame, and of course on the daily time frame we had seen that rally. The one thing is that the volume has been increasing on the way down. That's not what you typically want to see. You don't want it. What you want to see is just the opposite. You want to see the bigger volume coming in on the rallies, followed by lighter volume or diminishing volume on the sell-offs. So the volume pattern on this stock is a little bit of reason to just kind of step back and wonder if that means that this thing is going to fail. Right now we give it the benefit of the doubt because the daily chart looks so good, but I think you want to see how this settles in a little bit before you would decide to actually get long the stock. How about Mike Will? We take a look at EQIX. EQIX This has been a pretty decent stock here, as we've now got a rising 10, 20, and 50-day moving average. We look at the longer term. It's really just kind of consolidating here, though, at the 200-day moving average, and this has been a pretty important level before. First is, this support in here, then is resistance. It's trying to do battle with there, but we've got all this potential for supply here. You could draw a trend line on it and see that it's still kind of just touching on this trend line, but it's building energy. If it could clear maybe these highs of recent, maybe near 97.5 or so, then we would get another move higher. But it is holding the gains nicely. I think back above these recent highs, then you could get a move up north of 100 into this, maybe up towards 105 or so. And just looking at the weekly time frame, it experienced this bigger shakeout, and it's really still recovering from that. But we do have the higher highs and higher lows, so it's not a thrilling idea. I mean, it doesn't, just a super bullish looking chart, that is, but it looks decent. And Dan Conway is asking me about TiVo, and TiVo is just one of those stupid stocks, in my opinion. I don't even really look at it. It's just, how can you take a stock like this seriously? It's news oriented and rumor and rumors and lawsuits and that sort of thing. The trading is absolutely ridiculous. I saw this thing, and actually this is a good point. You see a little rumor of news and it takes off like that and just comes, screaming back in. We had seen that same type of activity in MDCO over here, where it on Friday it rallied up, pulled back deep, and then continued to rally. And then ID is a stock that seems to do this quite a bit. Yesterday, that is, that ID had taken off real violently and then just kind of came back in quickly. So that's kind of like a disturbing little pattern that I've seen in some stocks, that we have these super, people seem to get super excited about something. And I guess in the case of TiVo, it was likely and I can't type for some reason. TiVo is likely some kind of news, but Dan, I'm not the guy to ask about that. It's just a horrible looking stock. I wouldn't trust it. I don't think many people trust it, and it just seems doomed to fail. Kevin ONYC is asking about RIG, and RIG is one I've been discussing a little bit with my friend over at SMB, Steve Spencer. He's all over this stock, but it's got a nice pattern here. As far as you look at this daily chart, and we see what happened. We had bigger volume on these rally days, followed by two light volume consolidations. Okay, so we drill down and we can see that also, we had some resistance here that held as support. We've got a rising 10, 20, and 50-day moving average. Maybe we're going to make a run for the 150 or the 200-day. This is another one that's kind of news, stupid trades around the news. I mean, this morning it held that, it got above that VWAP and rocketed higher. The volume weighted average price held as support. Then it dropped below it. It became resistance, and then it completely caved in. So you have to have a strong stomach, I think, for RIG, because these are some pretty violent, 2-point swings, 2 points quick, 2 points down. And it kind of looks like the TiVo daily, where it just ramps all up at once and then distributes and then comes down all at once. So what I mean is TIVO. You look at that daily. I mean, it looks like this. On the 1 minute time frame, though, is what we're looking at on RIG, the same type of pattern. Anyway, the stock is healthy. It got back above the volume weighted average price. The volume weighted average price held as support, and I think that you can look at this and say, that which didn't kill it probably serves to make it stronger. It's consolidating underneath this $60 level. Is it going to be pegged to the $60 level for options expiration? Is what would come to my mind 2 days away from expiration. But I think above $60 a share is where it ought to probably make a run for these highs up near about $65 a share. It's again, it's impressive that this collapse didn't kill it. Instead, it came back stronger and really kind of shook the trees in there. So it looks pretty decent. What percent of MRX did you hold into the close today? And why? Thank you, Tony Lesotho. I held a small amount because it's boring. It's not doing anything. It's got a good looking chart. I held about 25% of it. But he's talking because I tweeted about it right in here saying it looked good on all time frames. I thought a stop should be about 29. Realistically, a stop should probably go below this morning's low after that shakeout down to the 5-day moving average. So a stop should probably be about 28.70. I was being a little bit probably too tight with the placement of that stop, but just because it didn't do anything. I thought it was going to take off right here. It didn't, so I am holding 25% of what I had bought. And if it gets above this level tomorrow, maybe 29.50, then I will add to it. But I just, I manage risk extremely aggressively, especially if the stock doesn't get moving quickly. Norm is asking me to take a look at KKD, and that's one that subscribers to Alpha Trends are long. We had gotten long right here above this little movement, so we had a stage 2 uptrend, little stage 3 distribution, stage 4 decline, stage 1 accumulation, and this higher high was where we purchased it with our initial stop. We put it underneath this low, and we had our stop at 335, which was perfect today because the low was 336, and I think Krispy Kreme looks good. I'm long some. I think it's probably headed up towards about $5 a share. It's kind of surprising that it hasn't gone a little bit faster. I thought when it broke this level that we were going to get a quicker move, but it acts decent. It's in a nice uptrend on that daily time frame, and the weekly it's got a lot of failed moves. That's something to be aware of. So you have to just manage the risk tightly. So, anyways, that looks like that's all the questions. So thanks for tuning in, everybody, and we will talk again on Friday.